Hi, I'm Jimmy. In this video, we're looking at my personal investment portfolio. We're looking at stocks I'm up in, stocks I'm down in, and then towards the end of the video, we're going to talk about a stock I'm considering adding to my investment portfolio to try to diversify it a bit, round things out. But before we jump into that, let me tell you real quick about an investing platform we're building. So we've got our private investing community hosted over on Discord. On Discord, we got a whole bunch of different investing channels where we all talk, share ideas, do some research projects together, and ultimately try to get better as a community at investing. We also do a couple investing live streams, private investing live streams every week. We do a valuation live stream, we do a portfolio live stream where we talk about my portfolio, we build the different portfolios. Plus we do a research live stream where we try to analyze companies together and go through the process together so we could all get better at it. Okay, now let me tell you about the website that we're building. So we already built the beta version of our discounted cash flow calculator. And the idea is that we would have a website that has a bunch of different valuation methods. So it could be, how do you value banks? How do you value a large cap company? How do you value a real estate company? How do you value a company with no growth or negative free cash flow or negative profits? There's different ways to value all different types of companies. So that's where the website's trying to go. For now, we've already got the beta version of the DCF calculator up there. We're just going to keep adding from there. Now, if you'd like to sign up to get access to our investing community as well as the website, I will leave a link in the description below. Okay, now back to my investment portfolio. So for this video, we're actually going to start with the largest position, work our way down to the smallest position, and then what we might do to adjust it. So my largest position is currently Microsoft. I bought Microsoft a little bit below $230 per share. By the way, I did that over a couple different purchases. Recently bought it about 3 or 4 weeks ago, averaged down a bit. Right now the stock's up a bit over 240, so I'm slightly up in this position. Microsoft represents about 13% of my total portfolio, which yes is on the large end, but I'm gradually adding more positions. I'll come back to that in a second. For now, my second largest position is Google, or also known as Alphabet. This one represents about 12% of my total portfolio. I bought this one at a bit below $120 per share. Right now the stock's around $100 per share, so I'm down a little bit in this one. Now these two together represent about a quarter of my total portfolio, which I'm totally fine with because I gradually plan on introducing new positions to the portfolio, which will slowly diversify away from their importance. But even if I didn't do that, all of my investments are long-term investments. My question, the fact that Microsoft is up and Google is down, is somewhat irrelevant to me because I've been in both of them for less than a year. So overall, because I'm in these for the long run investments, I'm less concerned about the fact that what the short run moves are. I fully expect over the next decade, both of these companies are likely to keep growing, albeit with a bit of volatility, especially in times like now where there's recessions in the broader stock market. But for now, let's jump over to my next largest position, which is a position with a bit more risk, and that's Alibaba. Alibaba represents about 11% of my overall portfolio, and we can see I bought it around $109 per share. It's currently around $119 per share, so I'm up a little bit in Alibaba. Now, Alibaba is a company based out of China. There comes certain geopolitical risks with an investment like that, although this stock is traded in the United States. But with that comes a certain amount of risks, which is why I say it's one of probably the most risky stock in my entire portfolio. For a while, it was one of the larger positions that I've had, and I've gradually tried to work that down. That's why I've added some to Alphabet, added some to Microsoft, and tried to diversify away from some of that risk. Although, again, I'm a long-term investor, so over the long run, I'm happy to sit to see where Alibaba goes. Okay, my next position is a company I really like. I've held it for a while, one of the longer holdings in my portfolio, and that's Intel. Now, Intel I bought around $38 per share. It's currently at about $30 per share, so I'm down a bit in this one. But again, as a long-term investor, I'm not overly concerned about this. When I first bought Intel, I recognized that there were some risks with Intel, particularly in their competitive battle against companies like AMD or Nvidia. But their value seemed good. I bought them what I thought was on sale. Clearly, could have bought it a little bit lower. It's at about $30 per share now. And I have averaged it down a bit. But again, overall, I'm happy holding this stock. Since I have bought it, the company has made a lot of moves to improve their production, they've spent a ton of money on research and development, continually trying to compete against the major semiconductor companies out there. So over the long run, I expect Intel and probably that entire industry to do quite well. So if I get the opportunity to average this one down a bit, I might continue to do so, but for now, I'm fairly happy with what I have. Okay, so my next position is another stock that's down a little bit, although one of the last ones down throughout the rest of the portfolio, and that is Meta Platforms. Meta, I bought at about $173 per share. It's currently trading around $140 per share. So it's down a decent amount. Now, when I had mentioned Alibaba before, you might have seen some hesitation when I said the riskiest stock in my portfolio, and I think that's true. The second on the risky scale, in my mind, would be a company like Meta. Meta is Facebook, by the way, and I like Meta. I like the idea of what they're doing. I like the massive reach that they have. But I have some question marks about the future, what they're doing with the metaverse. I have some hesitations about how well they're going to be able to execute that, although they have been able to grow the business up to this point. And considering that it seemed like it was on sale when I bought it, again, another one of those that probably could have waited a little bit longer. Over the long run, I'm more than happy to sit and give these guys the time to do it. They have plenty of cash, they're generating plenty of free cash flow. So as a long-term value investor, I'm more than happy to sit and wait. Okay, up next is a company that's actually one of my favorite companies out there, and this is Apple. Apple, I was able to buy around a little bit below 140. Right now, it's a bit above 140. I think around 143, 144. So I'm up slightly in Apple. This represents about 8% of my total portfolio. And this is one of those companies, much like Microsoft and Google, companies that I was really hopeful it would pull back into the value zone. We use our discounted cash flow calculator to try to come up with a fair value for the companies that I analyze. And when I had done my research, this is one of those companies that I was like, ooh, if it gets there, I'd be excited to buy it. Now, we might start to be seeing a pattern as to how heavily weighted my portfolio is in certain sectors, but we'll come back to that in a minute. But for now, let's jump over to a defensive holding that I have, and that is Lockheed Martin. So Lockheed Martin, I bought around $336. Now, I actually bought this before the economic trouble started coming and before the war in the Ukraine began. So those two situations have really helped a defensive stock like Lockheed Martin. Now, the good news is that when I bought it, I was deliberately buying it because the stock market seemed very high, and I thought getting defensive made some sense. Well, the stock's I bought it around 336. Right now, it's closer to 450. So I'm pretty far up in this position, broadly speaking. And this really helped me in the bad year of the past year in the stock market. My portfolio has been able to beat the stock market by a decent amount, and Lockheed Martin is one of the main reasons why. I have no intention of selling this one. I plan on having this as a long-term defensive piece of my portfolio, just in case things go bad. Companies like Lockheed Martin tend to do quite well over the long run. Okay, next up, representing about 7% of my overall portfolio is AT&T. Now, my average price is about $17.85, something like that. But interestingly, this is actually adjusted price. So I bought AT&T shares before they spun off their Warner Media division, and I had paid in the low 20s. And then when they spun off the Warner Media division, well, we got shares of Warner Brothers Discovery. We'll come back to that in a second. We got shares of that, but that drops the average price here because part of that price goes over to the Warner Brothers Discovery. Now, if you bought AT&T, if you own AT&T, and your brokerage firm hasn't adjusted it, I actually did a video at that time on the adjustment that was done. If you're curious, I'll leave a link in the description below to that video. But AT&T, I like better without the Warner Media division or Warner Brothers Discovery. I like it better. I like the pure play telecom business going up against companies like T-Mobile or Sprint or Verizon. I think that this company is better off in that business and over the long run likely to do fairly well. Now, this company pays a decent dividend, and if we are curious, I actually do not reinvest my dividends in any of the stocks. I very deliberately don't reinvest the dividends solely because I spend so much time looking at stocks and analyzing companies and looking for new investments. If a stock is up a bit, AT&T, by the way, is up to like $19 a share. So I'm up a little bit in AT&T. But if a stock is up a bit, I don't want to have my dividend reinvested and buy the stock at that higher price. I would much rather take that cash and pick the investment, decide where I want that money to go. So if you're curious, that's why I don't do dividend reinvesting. Okay, up next we've got Disney, one of my other favorite companies. This is one of the first companies that I bought. And Disney, I bought at about $96 per share. Again, I averaged down a bit. I originally jumped in at about $98, $99 per share. Averaged down when it fell into the high 80s. Right now, it's a bit over $100 per share. So again, another stock. Last four have been up in. So overall, these are really helping my broader portfolio performance over the past year. One of the reasons I'm beating the stock market. So Disney is one of those companies that, although they've run into some headwinds recently, I think over the long run, Disney's likely to do quite well, despite any short-term hurdles they might be facing. Okay, up next is a company I mentioned before, and that is Warner Brothers Discovery. Now, originally, my position came out of the spinoff for AT&T, but Warner Brothers Discovery represented about 1% of my overall portfolio. Well, once that spinoff happened, I eventually did a deep dive on Warner Brothers to see if it was worth making it a bigger piece of my broader portfolio. Now, Warner Brothers Discovery is a company that has a ton of good content and is a very solid business overall, and I think has a decent amount of upside. They do have some hurdles that they have to face as the Discovery and HBO platforms are being merged together, but I think that the company has a good chance of pushing forward and doing quite well with this stock. If you hear hesitation in my voice, it's because I think it's doing pretty good, but it's an I think, which is why it represents 6% of my portfolio and not 12%. I increased the overall position to make it a reasonable position size, but I haven't added so much that because I'm not as confident in this one as I am with some of the other stocks I own, like Apple or Alphabet or Google. Okay, then we've got Activision. So Activision is a company that there's been a deal announced that Microsoft would acquire Activision. There's been a lot of pushback about this deal. The government has stepped in to try to block it. And it's a coin toss as to whether or not this deal is actually going to get done. But I actually bought my shares before the deal was announced. Coincidentally, like 2 or 3 weeks before the deal was announced. And I paid about $63, $64 per share. The stock's up in the mid to low 70s. So I'm up in the position overall, but a lot of this rides on whether or not the deal goes through. The deal was by Microsoft, another stock that I own. The deal was by Microsoft, and the deal is supposed to be for $95 per share. But we'll have to see. Clearly, the stock market doesn't think that the deal is going to go through, with it being so far away from $95 per share right now. But I liked Activision without the deal, which is the reason I haven't sold it, which is the reason I'm happy to sit on this one, see where it goes. As a long-term investor, I'm happy to wait and see. If this stock goes to 95 and gets bought out, great. If it doesn't, I think in time the company should gradually grow, and I think that the company, as a long-term investor, should do quite well. Okay, then I've got a financial stock in my portfolio, and that is Citigroup. So I paid about $46 per share for Citigroup. Right now it's about $51 per share, so I'm up a bit in this one. Now this is another one of those that don't represent a huge piece of my portfolio. Now Citigroup is a very large bank, one of the largest banks in the world, but they've had some growth issues. Over the past decade or so, they've had very limited growth, and the company has put in place some plans to grow, which is one of the reasons that I was willing to buy them, one of the reasons that I did add them to my portfolio. But because they haven't really proven it yet, I'm only made it a relatively small piece of the broader portfolio. So that's why I have Citigroup in there. It was a diversifier, and if they do pull off the growth plans, it could do quite well in the bigger portfolio and really help my investments going forward. That being said, I've been looking for another diversifier to help spread away from my, let's say, tech or communication services heavy portfolio. Now, many people ask me, why do I have so many tech and communication services companies in this portfolio? How can you possibly call that diversified? And there's a very simple answer to that. Over the past year, tech, these types of companies have gone on sale. The Nasdaq's down like 40% over the past year. And I picked up companies that looked like they were going on sale because I believe that in the long run, being a value investor is most likely to outperform the market. That's where I've been focusing. Over the next 1 year, 5 years, 10 years, if utilities go on sale, I'll probably buy a lot of utilities. If energy stocks go on sale, I'll probably buy some of those. And in time, I expect my portfolio to gradually get more diversified. That being said, one stock that looks like it could be an interesting diversifier to my portfolio right now is CVS. Now, if I was going to add CVS to my portfolio, I'd likely make it an average size position. Call it 7-8%, maybe a little less, maybe a little bit more. Broadly speaking, I like CVS's business. They acquired Aetna a couple of years ago, and I think that they're well positioned to go up against a company like the Walgreens Boots Alliance. And from a value perspective, it seems like CVS looks like it's a good deal right now. So if we jump over to our discounted cash flow calculator, well, we can see that we're getting a fair value of about $118 per share. Right now, the stock is trading at about $86 per share. So there's a decent amount of upside. Now, if you're curious how this works, basically what we do is we take analyst estimates for free cash flow. You can see how many analysts are contributing to each company or to each year. We take analyst estimates for free cash flow. We discount those back to today. That gives us the fair value. The green number here is the fair value for the company after debt and cash are accounted for. In this case, the company has more debt than they have cash, so the fair value is lower than the number right next to it. Now, the other thing that is interesting on this to me is I was a little bit surprised at the current PE ratio, which is about 36x. Now, I was surprised that 36 is pretty high. The average for the S&P 500 is in the 18 to 20x range. So this being at 36, while simultaneously saying discounted cash flow, saying it's cheaper, seems a bit out of whack. Now, one of the reasons for that, so I looked into the details of it, and one of the reasons that the PE is so obscenely high is in their most recent quarter, CVS actually announced some one-time charges. Those one-time charges included things like they were in a lawsuit that they had to pay, it's like $5 billion for a lawsuit that they've been in for like a decade. They came up with a settlement, had to pay about $5 billion. But that should be mostly a one-time charge, a one-time hit. That $5 billion is a one-time hit. The other hit to the financials is a $2.5 billion write-down for they're selling their long-term care business, and the carrying value on their books is higher than the fair value of that particular business. It's about $2.5 billion higher. So when they announced that they were selling that piece of the business, they had to take a write-down for the $2.5 billion. Well, that ends up with another one-time hit to profit. That one-time hit makes profit much, much smaller, brings the profit from like $7 and something per share over the past 12 months to like $2 per share, whatever the numbers ended up being, which is why the the PE ratio looks to be so high. If we were to use adjusted numbers, and frankly, those would be the more logical numbers to use, if we were to use adjusted numbers, well, we can see that the adjusted numbers drop a decent amount. Now the PE ratio looks to be about 11x. 11x, again, is based on the adjusted earnings per share numbers going back the past 12 months. 11x looks fairly undervalued. Couple that with the fact that discounted cash flow says the stock could be undervalued, and this seems like this could be an interesting addition to my portfolio. I have nothing else like it in my broader portfolio, so I really think this could be a good addition to it. Now, I actually got CVS off of my bullpen and was actually recommended to me by one of the people in our private investing community. If you'd like to see a video on what stocks are in my bullpen, that is something that we talk about each week in the private investing community, let me know in the comments below if you'd like to see a video on that, because I could go through the companies that I'm considering buying and at what price I'm considering buying them. Besides that, if you'd like to join us in our private investing community, get access to our discounted cash flow calculator, I will leave a link in the description below. Got a link right here. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.